Hey, everybody, welcome back to another beautiful day in real estate. Today, we're going to continue our conversation from yesterday, talking about the cracks forming in the U.S. economy and how this is potentially going to play out over the next 6 months, the next 3 years. It is just before 8 a.m. We're at 7:57. The market's going to open in 3 minutes, and we're already seeing oil start to surge towards that $100 a barrel. We'll jump into that here shortly and explain why. Interest rates, as always, we'll jump into first 6.5% to that 6.1. FHA and VA are still around that 6% range, and if you're in good credit and good standing with the right bank, you could even get into the high fives. 6.5 for the conventional is pretty average as of right now. I'm seeing 6.37 in some cases, depending on, again, depends on the broker you use, depends on the lender you use. However, nothing's really changed as far as the amount of volatility when it comes to interest rates. We talked about this since March. I think that we're going to continue to see a very level 6.5 to 6% interest rate all the way through the rest of 2026. At the beginning of the year, we were very optimistic about seeing interest rates go down. However, inflation has continued to rise slightly. It's not the 9% that we saw in 2022. However, it is at 3.8%, I think was the core inflation that we saw most recently. The Fed's goal has always been to be at 2%. We did notice that there was some inflation coming down in Japan, which might trickle over to the United States, but it's a conversation for another day. But as of right now, I'm still going to consider seeing 6.5 to 6.0 range. I don't think they're going to raise interest rates at the next Fed meeting. I don't think they're going to lower them. I think it's going to be a consistent, unchanged situation. A lot of people are giving Kevin Warsh a lot of credit as far as saying he's going to cut rates. I don't expect it, because the reason that we saw he was on the board of Federal Reserve back in 2008, 2009, and he was the only one calling for interest rate hikes, or one of the only ones calling for interest rate hikes at that time. He didn't like the way that the Fed was continuing to low interest rates, continue to print money, and it was hurting the middle class, according to him, and according to some stories that I've heard. So he came in, and as a Fed president, he's not going to necessarily focus on interest rate cutting. He's going to focus on how can he reestablish the Federal Reserve to be the most beneficial. That's my opinion of him as of right now. I don't know. I mean, this is based off of what I'm hearing, what hearsay, conversations, his opinions on things. He's very focused on the new digital age, and we'll talk a little bit more about that later on. But as of right now, let's jump into jump into oil prices. Oil prices, again, close to that $100 a barrel. We talked about this a couple of days ago. A couple of days ago, we heard that the United States and Iran are no longer in peace deal talks, and that we could expect close to $100 barrel of oil again. This is WTI. Again, it's not. I forget the standard one everybody uses, but WTI is a little bit different than what we have. Man, I thought I had that one set up on here. Maybe not. But anyways, the point is that because the peace talks have ended in the Iran world, or they say they have ended, we have seen oil prices started to tick up. Now, they have continued to present opportunity for this deal to end, and I mean this deal to be essentially finalized. I believe this morning Iran was asking for like $600 billion for infrastructure rebuild after the war. You have a bunch of different conversations talking about the war in Lebanon, and they're saying they have to seize that war with Israel. Israel honestly just seems to be unchained at this point. It's kind of an awkward, weird thing to expect. Like, Jerusalem keeps kind of sandbagging everything that we talk about, right? Like let's get into it a little bit. So a couple weeks ago, or a week ago, we were close to the end of a peace deal, and then all of a sudden Israel is attacking Lebanon again, violating ceasefire agreements and things like that. It seems like they don't want it to come to fruition, which is absolutely remarkable, because Israel has been, no secret, they've been an ally of the United States for a very long time. I don't know if that could come to an end if they don't start to it probably won't, but realistically, if you keep breaking the rules, how many times can you break the rules before somebody's like, all right, we're done? You know what I mean? Personal opinion. But right now, like we talked about, oil prices are going to pump up to that $100 a barrel more than likely, until we see, again, some sort of concrete news that there's an end to the war almost here. Now, the one thing that we're going to jump into today, as we have been for a while, is the blow off top in the S&P 500. So we did see a little bit of a pullback here at the beginning of the week, but now we're moving into new all-time highs once again. And let's talk a little bit about why that's happening. Well, the S&P erases losses and surges to the highest level, record worth of $69 trillion. $69 trillion. I don't think people realize the amount of money that really is, okay? The stock market was valued at 84 billion in the I think it was, or 84 trillion, I believe, in what was it in 2021? I think it was the peak of the bull market, $69 trillion. So remaining, I don't even know. I got to look what the stock market's valued at right now. But in my opinion, this is the most overvalued it's ever been. And the reason is because so many people are confident in AI, which is remarkably concerning. Again, we have to pay attention to crashes in the past, right? And I'm a big fan of Coach JV. He's a big fan. He's a big mentor of mine, whether he realizes it or not. But he got me introduced into the economy and understanding cycles and understanding what to be paying attention for. And when you see overconfidence in the market, you start to notice that it gets to a point where people start leveraging pretty significantly. Now, this is, I'm going to pull a few small things and we'll kind of talk through them as we go here. But you guys, potential stock market crash warning: the last time the S&P 500 rose as fast as it did over 2 months, excluding recessions, was just before 1987 Black Monday. And for those of you that don't know, that was one of the biggest crashes in the stock market in history. And when we see it, I mean, I don't know that one very well, but it's a very well known thing in the trading world and in the investment world. It was the worst crash we've ever seen. I don't even know exactly what happened, but I do know that it was one of the worst crashes we've ever seen. So what happens is companies get over leveraged. They start leveraging their money. They start leveraging their capital. They start leveraging their assets. And then the market eventually gets to an over leveraged point. So just like anything else, like I traded leverage for some time, right? And when I was trading leverage, you start at like 5% leverage and you kind of trickle up from there. And then one day you're bored and you're over caffeinated, you're jazzed up and you're like, let's try 100% leverage. You know what I mean? And you start to get cocky because you're winning. And that's exactly what happens with these firms. When they have a continuous winning record, they think that they're unstoppable and they will continue to leverage until they can't anymore. And what happened is right now is there's so many companies that are over leveraged into AI right now. They're focusing on AI. They're saying AI is the next internet, the next big boom, the thing that's going to change the world. They are correct. It will. But I think we're still a little early to what it actually is the implementation of is going to be. When you see something increase this quickly, there is no sustainability behind it. We could talk about cryptocurrencies in 2021. We saw insane amounts of return across the market, across the crypto market. No regulation, no security, no understanding of the market in majority. Coins that had literally zero value, literally zero intrinsic value. There was no value from the company. It was literally a dog on a coin, and it brought thousands of percent return to the point where people over leveraged and bought at 10 cents, whatever it was. It went all the way up to $1 something, and people made a lot of money. But a lot of people are still holding the bag today, hoping that this is going to reach $100, hoping it's going to get to this point. We've gotten to a point where trading is consistently more of a gamble than an actual concentrated investment. Again, I will always bring up why real estate is very important in hard assets, because when you invest into hard assets, there has to be some sort of strategy behind it. I mean, some people who just have money to throw away will take $100,000 and throw it at the real estate market and just start doing flips or whatever. But the thing is, you have to have some sort of exit strategy to go along with it, right? The same thing with gold, the same thing with silver, the same thing with any sort of investment you do. But a lot of our generation, the younger generation, I should say, because I'm still 28. I mean, I'm not old, but I'm not young anymore, right? I'm kind of in the middle. I'm starting to establish. And a lot of the people my age are still struggling to make ends meet and pay for the bills just to get to their rent, just to get everything taken care of. And those people are looking for a way out, and the way out to them is maximizing a gamble. They are looking at it as an investment. They're saying, "Oh, I've been hearing that SpaceX is going to IPO and it's going to go to this, and the valuation's $1 trillion and blah blah blah." Same thing with AI. AI is this new trend that I shouldn't say new. I mean, it's been established since 22. We're 4 years deep into it, but you're seeing a time where everybody believes that they can just put money in and they can't lose. And when it gets to that point, it gets very dangerous and very scary, because people are leveraging money right now and spending money they do not have. They are investing money that they don't necessarily have to lose. And that's the number one rule of investing. Do not invest money that you cannot afford to lose. You have to take some risk to it, but you have to take an educated risk. And right now, most people aren't taking the educated risk. They're just seeing AI is getting pumped in. They're seeing headlines that Alphabet and Google are investing, some $100 billion into AI. You're seeing companies like OpenAI talking about the future. You're seeing Claude. You're seeing all of these AI integrations, And don't get me wrong, it's moving quickly. It gets establishing a lot quicker than the internet, but it's also over leveraged a lot more. You have companies already missing earnings reports and they are valued at 5, 10x what they actually should be valued at based off of those earning reports, right? That's the concerning thing for me. That's what really draws it in, right? So semiconductors is a huge portion of that. Semiconductor stocks are now trading at 73% above the 200-day moving average, the largest margin since the dot-com bubble. Again, we're going to reference it because we're talking about the same concept, right? We're talking about an evolution in technology. And when you have an evolution in technology, many people think that they know better than the rest of the world. They know better than the rest of the market. They say, I know what's going to happen, so I'm just going to put money in and hope for the best. The problem that we're seeing now, though, is that these semiconductors are such a ginormous portion, and that's exactly why the S&P is ripping so hard. 20% of the S&P 500 is AI-based companies, and those companies are ripping to the point. That's what's drawing up the price, right? Because AI companies are somewhat established to a point where there is so much confidence, and you see earnings reports are going up in some cases, right? It's not every company's losing earnings, right? Like you have a lot of companies that fired a portion of their employees to use AI to be more efficient, more effective. And when you have less employees to pay for it, obviously you're going to make more money as a company, right? So as we get through this, this is the blow off top that I am anticipating. If I eat shit in the next couple of years, I do not care, and it continues to go up. It is what it is. I'm making my decision and holding my opinion here because when you see something of over leveraged, like things over leveraged to this point, I don't care who you are. What goes up must come down, and what goes up quickly will come down even harder. So right now, let's just talk about that for a second. And hedge funds, you guys are now starting to get to a point of short exposure, highest level in at least a decade. So the last time they were this high was over back in 2016. I mean, before then, geez Louise, I mean, you had the leverage in 2021, but keep in mind, when did the bull market peak? The last bull market, 2021. And down to essentially the bottom of the bear market, which was 2024, which had the Bitcoin halving, which is another conversation. But now we're getting to a point of over leverage, like leveraging the shorts, right? And I mean, I'll be honest with you, it's starting to look like I might pull my bootstraps up here, and I might put some money into some shorts here soon too, depending on. I mean, I have to do some more research to really understand what I'm putting my money into, but things don't seem right. When you have an economy that's struggling this hard to make ends meet, to pay the bills, to survive, to buy a home, these sorts of things, but the stock market is somehow the highest it's ever been in the middle of a war, something just doesn't feel right about that. And again, it might rip. It might rip for the next year. It might rip for the next 18 months. It might rip for the next 6 months. I don't know. But what I can tell you is what goes up this fast will come down even quicker. And that's what we should be paying attention to. Now, most options traders, again, now we're talking options traders, which is a little bit different than Wall Street, right? I mean, there are option traders on Wall Street, but they're going to be talking, a majority of these people are leveraging their money. What are options? You're leveraging money at some sort of 2x, 3x, 4x, 5x, 10x, right? So you can basically take $100, you can bet $1,000 that you're going to be right? So you can basically borrow money is what it is. Options traders are now the most bullish on the stock market in more than a decade after a total put call ratio plunged to 5.58. So basically, there's a ton of people that believe that this market's going to go up forever, and they're leveraging right now. When you get to a point of leverage, this is, again, I'm going to repeat this 100 times over. When you get to a point of leverage, people are screaming for help. People think that they know what's going on. Some people are going to be out there trying to make ends meet, and they're gambling on this one last hurrah. Maybe I can leverage all this, and the stock market's going to go up, and I'm going to pull profits, and I'm going to make all this money. What's going to happen is what happens in every bull market or every blow off top, where the retail investors start to get too confident and Wall Street starts to take advantage. And they will, because it's just how that works, right? We're just in that. That's just how human mentalities work. When they see something green, they go after it. I am a big fan of red. The more the market's red, the better I feel. Granted, I haven't been in the stock market for the last few years. I haven't been confident in it for a long time, and I'm probably kicking myself now because I could have been buying stuff in 2024 and I didn't. I was focusing on other ways to invest and build my companies. But anyway, so the next thing we're going to touch on, U.S. consumers are carrying more credit card debt than ever. Last year, 21.3% of U.S. credit card holders, had over $10,000 in debt, the highest in at least 7 years. All right, let's go back 7 years, 2019, right? The percentage has been risen for 4 consecutive years from 15.3% in 2021. So again, what happened in 2021? That was the peak of the last bull market, right?
By income, 25% of higher income households have over $10,000 in credit card debt in 2025, the highest among all income groups. Okay. This was followed by middle income and lower income households at 20 and 17% respectively. Meanwhile, the US total credit card debt stands at 1.25 trillion, nearer an all-time high, surging 360 billion since 2020. Consumers are increasingly relying on debt to keep up with rising prices. This is a very, very dangerous thing to do. I knew somebody, a buddy of mine, a couple of years ago, was telling me about this. He was in credit card debt, and he went out and he just kept getting new credit cards, and he would transfer the debt over to the next one with a promo saying 18 months, no interest, etc. But at some point, things run out of room to roam, right? At some point, you get to a point where there's no longer a promo. There's no longer a way to restrict your debt, and you will have to pay it off. Right now, most people are struggling so hard to make ends meet that they are using credit cards to pay the bills, to get food, to pay for electricity. And until there is a sustainable leveling, which will happen, I mean, there's no way that this market doesn't correct in some way, shape, or form. Because again, the big thing we have to pay attention to, and I'll talk about this in another day, but we're moving into the digital age. We're moving into where everything will be digitalized. Your ID, the money you use, the debt, your car title, your deed for your home, digitalized, digitalized, digitalized. Why do you think they are focusing so much on AI facilities and server facilities? Because when you build something like this and everything goes to the digital space, you need to have infrastructure. Right now, the United States' electricity grid is nowhere near sustainable for what they want to do. Nowhere near. That's why you're hearing conversations of Elon Musk saying that he wants to partner with some companies to essentially put AI data centers in space where it's sub 0 degrees and you can pull solar power from the sun 24/7. Right. So they're basically going to space now because we've ran out of room for infrastructure in the world. Right now, there are the biggest data center of all that we've ever heard of is being backed by Mr. Wonderful, and he's building it in Utah because he sees exactly what we're doing, and that's moving towards a digital age. So that's where this transition is really coming into play. I think, and this is my tinfoil hat, but bear with me here for a second. But I have good authority to believe that we will get to a point where the US dollar will no longer be the only dominant currency. I believe that all currencies are going to be equal in the next decade, meaning because we're moving into a digital phase, and the digital phase is transacting money from one position to another and being able to settle instantly, right? If you can take that intermediary and go from the yuan to the pound to the US dollar, and literally have it settle instantly, transact across border payments, which CCIP, cross-chain interoperability, is what it's built for. And if you guys saw, there was an article that came out with Citi talking about how they were implementing this. Citibank, by the way. We're going to get to a point where people and countries are no longer going to need to rely on the US dollar to be sustainable. And that's where the US dollar is getting weaker. And that's why people are moving away from bonds. That's why you see countries having the highest level of gold holdings they've ever had in history. Well, in recent history, I should say, because they're going away from the paper backed promise. They're going back to a physical backed currency, physical backed currencies, I should say. And cryptocurrency is going to bring that to a blockchain, whatever you want to call it. Stablecoins are a little bit of a different conversation, but that's what the whole concept of blockchain is. And right now, the blockchain is the most bearish I've seen it in, well, quite a long time, to be honest with you. We're at extreme fear consistently. We're seeing that Bitcoin's broke below that $70,000 mark again. We're seeing that the altcoins have gotten completely obliterated, but you also are seeing tons of companies starting to invest more and more into this infrastructure. JP Morgan came up with an interview talking about stablecoins and how they're fighting the Clarity Act pretty aggressively, because basically what can happen with stablecoins is you can make interest off of your money. Now, I'm not going to share how much particularly, but I have a large sum of money or a decent amount of money in one of my accounts for my business accounts, right? I have to keep my rainy day fund, if you will, and I made $21 on interest. $21 on interest, and I'll tell you that is nowhere near what's in that account right now. People are wanting to increase their value of money. And that's why the Clarity Act is so valuable and important, because by creating something where currencies are moving towards digitalizing, and stablecoins is the perfect representation of going from one currency to another and doing it seamlessly. you can use things such as Venmo and Cash App is essentially the beginning stages of it, where you can transfer currency or transfer money from one person to the next and it settles instantly. It doesn't, but the company basically takes a promise saying, oh, you have $200, you're transferring it to here. We'll substitute that $200 so that when the transaction settles, we'll keep our $200 and we'll charge a fee to do so, right? You're acting as an intermediary. Now, if you get to a point where currencies now can transact and I can send money from me to you in 2 minutes and it settles the transaction fully, there is no promissory. It's just from me to you, I'm using the rails, I'm going from me to you, it's going to settle immediately. You no longer need the liquidity to back those promises, right? So again, different conversation for a different day, but right now we are seeing the blow off top in the S&P 500. I believe Bitcoin will follow later on this year. I think right now we have to see that Clarity Act come into play, and once that gets signed by the president, I believe closer to the midterm elections is when we're going to see the market tear. And if it does, I have all my exit strategies set in place. If not, I have my investment strategy as well, because I'm a firm believer in what I'm invested in. So that's what I have for you guys today. Be very cognizant about what you're investing into. AI is overhyped. It's overvalued. The stock market is overhyped. It's overvalued. And there will be a time when that market does correct. Right now in real estate, you're seeing a lot of people who are very confident in the stock market. I'm selling homes. As a new construction person, I'm getting cash offers and cash buys because people are taking money from their retirement to invest into real estate. And I always joke, this is a good idea. The stock market's overvalued. And I had a gentleman the other day sit down with me. We were bullshitting. And I was like, how's your portfolio doing? And he's like, ooh, it's doing great. And he's like, that's why we're buying a house. He's like, because now, he's like, if the market goes down, he's like, I've got another asset to invest into. So anyways, long story short, pay attention, be cognizant, like and follow for more content. We're going to keep diving in and explaining this stuff because it's important that all of you know that if you want to be an investor, be in real estate as a whole, if you understand the economy, you will thrive in this industry. Thanks for watching. Have a blessed day.